Hello and welcome back to Crypto King. The current state of regional banks is a cause for concern as we witness a rapid succession of failures in 2024. This is not speculative fear mongering, but a reality that's already unfolding. Last year, the banking industry experienced significant turmoil, culminating in the collapse of notable institutions such as Silicon Valley Bank, Signature Bank, and First Republic Bank. The domino effect continued with Silvergate Valley Bank and Heartland Tri-State Bank also succumbing to insolvency. The combined assets of these failed banks amounted to a staggering $440 billion, marking the most substantial collapse seen since the establishment of the Federal Deposit Insurance Corporation. The severity of the situation prompted the FDIC to intervene, utilizing a significant portion of its insurance funds to cover the losses incurred by these failed institutions. This raises a critical question about the FDIC's financial stability. How much reserve does it have left to address potential future failures? Unfortunately, a closer examination of the FDIC's financials reveals a troubling reality. The available funds are alarmingly depleted. This analogy of the emperor has no clothes underscores the vulnerability of the FDIC and the broader banking system. The FDIC, once seen as a bastion of stability and assurance for depositors, now appear exposed and adequately equipped to handle these escalating crises in the banking sector. The depletion of FDIC funds not only undermines depositor confidence, but also raises doubts about the government's ability to safeguard the integrity of the financial system. As regional banks continue to falter and the FDIC's resources dwindle, the looming specter of further bank failures casts a dark shadow over the economy. It's imperative for regulators and policymakers to address these systemic vulnerabilities promptly and decisively to mitigate the risk of a full-blown economic collapse. In 2024, while widespread catastrophic bank failures have not yet materialized, there has been a concerning trend of regional banks collapsing with alarming frequency. This pattern suggests that it may only be a matter of time before a major bank succumbs to the same fate. Concurrently, these failing small banks are being assimilated by larger financial institutions, a phenomenon driven by several factors, chief among them being the precarious state of the commercial real estate market. Commercial real estate loans are a central pillar of many regional banks' portfolios. However, in the current economic climate, a significant number of these loans are reaching maturity, presenting a substantial challenge for small regional banks. The prevalence of flexible 5-year rates on the commercial real estate loans compounds this issue, so borrowers now face significantly higher rates upon renewal. This sudden spike in interest rates puts immense pressure on both lenders and leaseholders alike. The commercial real estate sector has been profoundly impacted by the shift to remote work, resulting in soaring vacancy rates in office and retail spaces. Many buildings now stand empty or largely vacant, exacerbating the financial strain on both property owners and financial institutions. With properties remaining unoccupied, generating little to no revenue, owners struggle to meet their loan obligations, further burdening already distressed regional banks. Refining these commercial real estate loans has become increasingly challenging for small regional banks. A lack of assets and funds impedes their ability to offer competitive refinancing options to borrowers. Additionally, many leaseholders are reluctant to pursue refinancing as the current value of commercial properties often falls short of their outstanding debt. With interest rates on the rise, the prospect of refinancing into a higher interest loan is unappealing and financially imprudent for both borrowers and lenders. The heavy reliance on the commercial real estate sector on debt exacerbates this situation. When the terms of this debt become unfavorable, the resulting losses must be absorbed by someone. High-rise office spaces in particular are experiencing substantial losses, as evidenced by the defaults of major companies like BlackRock on their commercial loans. Despite regulatory efforts to maintain stability and instill confidence in the banking sector, inherent risks within the commercial real estate market persist. The looming threat of further bank failures, coupled with the challenges posed by the commercial real estate market, underscores the fragility of the current economic landscape. As small regional banks continue to struggle, the consolidation of the banking sector into larger entities accelerates, further concentrating power within a few dominant institutions. In such uncertain times, proactive measures and robust regulatory oversight are essential to mitigate systemic risks and safeguard the stability of the financial system. Former FDIC Chair Sheila Bair has spoken candidly about the challenges ahead. Former officials like Bair often provide more forthright insights into the turmoil that's unfolding and what might come next. We're in a similar situation than last spring, still facing the risks of uninsured deposit runs. Regulators need to address this and seek reinstatements of the FDIC's emergency authority from Congress, while they're trying to mitigate the issues through lending facilities at the Fed and federal home loan banks. This is only a temporary and expensive solution. Uninsured depositors might not feel secure knowing that banks can borrow from the Fed. If they think the bank is in trouble, they'll be worried and possibly withdraw their funds. Banks with significant portions of commercial real estate in their portfolios are particularly vulnerable. Small banks are at high risk of incurring substantial losses. Federal Reserve data from September 2023 shows that the commercial real estate makes up 44% of portfolios of small banks compared to just 14% of the country's 25 largest banks. This disparity indicates that many small banks are likely to be absorbed by larger ones. As this consolidation occurs, major banks like Bank of America, Wells Fargo, and Chase will acquire these smaller banks, leading to a greater monopoly in the banking industry, a situation the Federal Reserve seemingly desires. The collapse disproportionately affects smaller and mid-sized banks, especially those not well diversified and reliant on commercial real estate loans. Historically, regional and community banks have maintained a higher percentage of their balance sheets dedicated to commercial real estate lending compared to larger banks. This strategic focus on commercial real estate has been a defining characteristic of smaller banks, making them more susceptible to the repercussions of fluctuations in the commercial real estate market. The reliance on commercial real estate lending exposes these smaller banks to the adverse effects of a downturn in this sector, when the commercial real estate market experiencing challenges such as vacancy rates or declining property values. It directly impacts the financial health of these banks. Unlike larger institutions with more diversified portfolios, regional and community banks have a significant portion of their assets tied up in commercial real estate loans. Consequently, any downturn in this market segment can have a disproportionate impact on their balance sheets. What compounds the issue is that these smaller banks often differentiate themselves by offering more competitive pricing and cultivating strong relationship-based products with their clients. Their local presence and personalized interactions allow them to develop deeper connections within their communities. This approach not only fosters loyalty among customers, but also enables these banks to tailor their services to meet the unique needs of their clients. However, when these smaller banks fail, their business is absorbed by larger financial institutions, leading to a loss of the competitive pricing and personalized service that customers had come to rely on. Larger banks typically charge higher rates on banking products such as credit cards and personal loans, resulting in increased financial burdens for consumers. In a country where credit card debt has reached an alarming $1.1 trillion, the prospect of losing access to more affordable banking options is deeply concerning for many Americans. The collapse of smaller banks exacerbates this issue, further limiting the choices available to consumers and potentially driving up the cost of borrowing. The events of 2023, widely regarded as one of the worst years for banks since the 2008 financial crisis, serves as a stark reminder of the fragility of the banking sector. With regional and community banks facing mounting pressures from the commercial real estate market and larger economic forces, the outlook for 2024 and 25 remains uncertain. Ultimately, the safety of one's money in the economic current climate is precarious. Stock market volatility, bond market fluctuations, and the potential collapse of financial institutions all contribute to heightened uncertainty. In such times, tangible assets that can be physically held provide a sense of security amid economic turbulence.